Hi, my name is David Cataford, CEO at Champion Iron. We operate an iron ore mine in the north of Canada, one of the best jurisdictions to produce high-grade iron ore in the world. We produce roughly about 15 million tons per year and are now delivering our third project on time and on budget to transition half of our tons to one of the highest grades of iron ore in the world, which will fetch a much higher premium in the future as steel producers start decarbonizing. Management owns over 10% of the business, so we're fully aligned with shareholders to be able to maximize the returns due to this high-grade iron ore material.
David, good to see you. Been a while. Why don't we start with the kind of the Q2 numbers? We'll have a romp through those and then get into the weeds a little bit. So what do we need to know?
This has been our best quarter in the last 2 years. So we hit about $175 million of EBITDA during the quarter. Record sales. So we had a bit of a hump when we delivered our expansion. As you remember, we chatted a few years ago. So we delivered our project on time and on budget, but on the logistics side, struggled with the third-party rail operator to be able to hit the same numbers as we were producing. Hence, we hit a pretty big stockpile at site, roughly about 3 million tons of high-grade iron ore. But now we started destocking that material. So we had about 4 million tons of sales during the quarter, and we should be able to continue destocking that, which will generate significant cash for the company in the next quarters.
Right. Okay. As you say, kind of rail outage and scheduled maintenance, kind of with some of the key limiting constraints. As you kind of work your way through that pile, because I'm thinking you've shot out of the gates quite quickly, but does that kind of level out eventually, or does it kind of drop off? And what's the future hold?
Yeah, so at site now, we're pretty much hit our nameplate capacity in terms of production. So everything is rolling pretty smoothly on that side. We are going to transition to a higher product at the end of this year. So half of our tons will then be upgraded to roughly about 69% iron, or one of the highest grades in the world. And this project is due to be delivered in December of this year. So beginning of next year, we're going to start selling those tons into the market and should be able to maintain that nameplate capacity as we ramp up that project.
Okay, interesting. How much of that recovery improvement came from sort of blending strategies versus processing optimization?
Yeah, so if you go back 2022, we delivered a project roughly about $750 million upgrade to be able to double our production. The main highlights obviously is this new plant was optimized, so we were able to increase our recoveries, which definitely helped to be able to maximize the tons at the site. We're still working through some elements on the blending side, as you mentioned, to be able to maximize the amount of tons that we can deliver from site. But realistically, when you look at our two separate plants, they're geared now to be able to deliver on the type of ore that we have at the mine for the next decades.
Okay, and what about things like, I noticed the stripping ratio increased slightly. Again, what does that look like now versus the kind of rest of life of mine plan?
Yeah, so our strip ratio right now is a little bit higher than our life of mine. So we had a little bit of a catch up to do. If you remember when COVID hit, we were one of the only projects here in Canada that was able to operate through the whole lockdown. But we had to reduce a little bit the cadence in terms of the amount of workers at site. So we did have a little bit of a waste backlog, which we've now recovered. That's probably what you've seen in a little bit of higher strip ratios, but they're pretty much in line with what we're going to see in the next years. We now have all the mining equipment on site to be able to deliver the numbers that we need to hit the nameplate capacity of our plants.
Right, and on the converse, we saw a little bit of improvement on the kind of C1 cash costs. So where's that come from?
Yeah, if you look at our site, we're pretty heavy in terms of fixed costs. So obviously, if you look at the past quarters, because we were not necessarily hitting all of our numbers, that definitely affected our cost per ton. Second part is we did have to stockpile quite a lot of material. So if you look at our site, it's not designed to hold material. That's not our strategy. So we had to creatively find some new areas to stockpile material, but that meant loading small trucks and hauling material back and forth at a few kilometers away from where we typically load our material. So that also increased our costs. But when you look at our costs going forward, well, as we improve our production and we get rid of that stockpile, well, definitely that's going to improve and continue improving on our cash costs.
Okay, and I saw that the kind of realized selling price was around just over like $92, $93 versus the kind of P65 index. Well over 100. Why is there a discount at this stage?
Yeah, so when you look at that number, we net it from freight. So the number that you have in your mind for the index that is delivered to China. So if you look at freight costs, the C3 was in the area of about 23, 24, $25 per ton. So if you discount the freight cost, well, that puts us pretty much in line with the P65 index.
Right. Okay. Understood. Understood. Okay. And what about inventory levels at Bloom Lake? I mean, how much did you go through up to the end of this quarter? And what are you targeting for end of year 26?
Yeah, we had almost 500,000 tons that were removed from our stockpile and sold. So that's what helped us deliver record sales of roughly about 4 million tons during the quarter. We are continuing to bring down tons from that stockpile. Hopefully in the next few quarters, we'll be able to run down all of that stockpile, generate that cash, and be able to make significant returns for our shareholders. I mean, if you look at our company, we've been investing heavily for the past 7 years. So we've been on a pretty big CapEx run since 2017 when we started our first project, then doubled our production, now producing this new material. So we invested just over $2 billion in the site, but that cycle pretty much ends in December this year once we deliver our new plant. So we'll be in a situation to generate cash from our stockpiles, but also from the cash from the improved grade that we'll be producing at site.
Obviously, obviously you've had to come up with a solution for this in terms of those stockpiles, etc. Yeah, are there kind of levels of efficiency or lack of efficiency that you're seeing now due to things like stockpile rehandling or degradation or etc., which will again be removed as you kind of start to optimize?
Yeah, there's a few things. I mean, even if you look at the last quarter, we had a major shutdown at our site. It was the best shutdown we've ever had. We have 2 of those per year. And this is due to the fact that, I mean, we delivered the plant in 2022. So to work through the little hiccups of starting up that plant and being able to be more efficient, that allowed us to have a very good quarter in terms of production, even if we had that semi-annual shutdown. So as things go forward, we're the type of company and the type of people that really try to find all those elements that need to be improved, work on them, and last quarter was a real example of that.
Right. Now, because you made the point, it's been a great quarter for you financially, but obviously the market's maybe not leaning into iron ore much. So, EBITDA, great number, net income, great number, but share price, not so much. What is it that people need to recognize about the kind of phase that you're going through in terms of whether it be accumulation of cash or optimization or building up to, when Kemi comes online?
If iron ore price stays where it is now, I mean, we'll be generating loads of cash in the next years. What happens is that a lot of the market turns to analysts that all forecast iron ore to be lower in the future. We've lived through that since 2015. So, I mean, if we would have listened to analysts, we never would have bought a $5 billion asset for $9 million. But realistically, that's what helped us create that foundation. And every year now, analysts have said next year iron ore price is going to be lower, yet the price holds. What people often overlook is the fact that China produces over 450 million tons of iron ore at a pretty high cost. So what analysts focus as a next year's price doesn't seem to account for the fact that if the iron ore price goes down, China's going to curtail some production and iron ore price is going to go back up. We've seen that in the past 4 years. Iron ore price goes under $100, then there's curtailment of production, goes right back up over $100. And at these sorts of prices, we generate significant returns.
Right, and what do you tend to do with it? What's the best allocation of that? For like, if I look at some of the things which are going to affect you, things like the senior notes, the kind of the net financing costs, etc. What do you direct your money towards, and what do you explain to your shareholders or wannabe shareholders as the best allocation of capital for a company like yours at this moment in time?
So if you look at our company today, we started paying a dividend a few years ago. So we've maintained that semi-annual dividend through time. We want to continue that strategy to return capital to our shareholders. We have very loyal shareholders that have been up with us for a long time, and we definitely want to be able to keep capital return strategy in place. On the other hand, we've just delivered over $2 billion worth of projects. So we have taken on a little bit of debt, and part of our strategy is to be able to delever that as well. We're not excessively exposed in terms of debt. I think we've always been very conservative through all the calls that we've ever had. I think you've seen the way we operate, very conservative in terms of balance sheet, but still we would like to have a portion delevered, and at the same time review the next steps of capital allocation, because as we mentioned, we're coming out of a large CapEx cycle. So 7 years investing in our site to get us to where we're at now. We'll be generating much more cash over the next few years. So we'll be evaluating what's the best return for our shareholders. Do we increase the dividend, or do we look at share buybacks? Because at these prices, I mean, if you look at our company, we've got over $6 billion US of replacement cost for our site, and we've got a market cap under $2 billion. So definitely there is a view that to buy back our own stock could be a accretive strategy for our shareholders.
Okay, interesting. And so just coming back to a previous point you made with regards to obviously shutdowns, and you talk about having had a good recent shutdown. What's your expectation for maintenance cost normalization in 2026? What does that look like going forward?
Yeah, so if we look at costs for next year, obviously we're not a company that gives guidance, but realistically there's still areas that we can improve. So as we bring down that stockpile, that's definitely one of the areas. Because there'll be less back and forth hauling material. But then if you look at also what we can control in terms of our iron ore recovery, we are working on better blending strategies at site. I mean, we understand our ore more and more. It's a very stable ore, so that's definitely going to be able to allow us to tweak the plants to be able to increase recovery. And then on maintenance is the other area where we definitely can continue to improve. So our teams have now finalized the way that we want to do our maintenance. We now have set weeks during the year, so it sounds a little bit silly, but that means contractors know when they come to Bloom Lake to be able to do the maintenance. So we've reserved our contractors years in advance to make sure we get the best during that period. So there's all these small tweaks, but as we continue to optimize, that's definitely going to help reduce our cost per ton.
Okay, and can you give me an update on that was the thing we talked about last time, the DR pellet feed? What's the news?
Yeah, if you look at the DR pellet feed, it's a $500 million investment. We're putting an add-on to one of our plants to be able to produce one of the highest grade materials in the world. Why we want to do this? One, it's going to help sell tons closer to home. Today, we've got about 9 million tons per year that are being sold into China. Well, by producing 7.5 million tons of material that's higher grade, we want to sell more into North Africa, Middle East, and in Europe. So that's going to reduce significantly our shipping costs, while at the same time increasing our premiums for our material. So that's definitely a big highlight, and we've chatted about it for a few years now, but the project's getting delivered this December. So come next year, we'll be starting to deliver those tons into the market.
And how much of on-spec capex remains?
So right now we've got roughly, if you look at our plant today, we need to finalize piping and finalize electric work. So we spent already over 80% of the capex, but we've committed more than that. Realistically, when we look at potential cost overruns, I mean, we're basically finished. We're a few weeks away from delivering the plant. So we're very comfortable we'll deliver that project on time and on budget, as we've done with the other ones before.
And that's, into first half 2026 in terms of commercial shipments, yeah?
Correct.
Okay, revenue. Cool, okay. And what you mentioned, maybe just selling more locally. Okay. With regards, so you said so much. It was like on the dividend front. Obviously, what did that look like last year? Would that remain the same? It's sort of semi-annual dividend payment, wasn't it?
When we look at our company, we're listed on the ASX and on the TSX. On the ASX, typically dividends are semi-annual, so that's why we followed that same strategy. So we have 2 dividend payments per year, and we've paid 10 cents per share in the past 2 years. Right. And the past 4 years, sorry.
Okay, so that's revenue. And then the next thing you talked about, if we're delivering into Kami into 2026, what's the sort of contribution there from Kami? You talked about that before, haven't you?
Kami, yeah. So if we talk about the Kami project, so that's one that we've definitely had some large announcement since last time we spoke, because we finalized the deal with Nippon Steel and Sojitz, which have invested in our project. So they've bought basically 49% of our Kami project. Now, if we look at Kami, what is it? It's going to be a 9 million ton per year high-grade iron ore producer, just a few kilometers away from our current mine right now. So we sold down a little bit less than half to very good Japanese partners of ours. And the way that we've structured the deal is basically the equity portion that they're buying in is going to allow us to pay for the next steps for the next few years for that project. So there will not be any shareholder money from Champion that will be invested in that project over the next few years, but we're going to continue finalizing the permitting, finalizing the feasibility study, and then potentially be in a position in 2027 to take a decision on the next steps of Kami. But I think one interesting thing to highlight when you look at Kami, if you go through the feasibility study or the pre-feasibility study that we delivered, it seemed to be a pretty high cost. The CapEx was a little bit high because there's roughly about $800 million of infrastructure work that need to be done to be able to get Kami up and running. When you look at that investment, it makes a lot of sense that the federal and provincial governments be able to contribute a large portion of that, because it doesn't only help Kami, it unlocks the whole region for other projects. So we have been in discussion with the federal governments and provincial governments, and there has been quite a lot of interest on the Kami project to be able to deliver new power and also port infrastructure to help us go along. So as that unfolds in the next years, might make Kami a very interesting project to be able to deliver to the market.
Okay. We'll come back to that another time. In terms of just answering a sort of question, which thing, as you say, brokers have got a different view to you about the future. Can you talk about the mechanisms that you use to kind of protect yourself going forward, like contract structure mix, for instance, or backward versus forward indexing? I mean, how do you protect yourself go forward?
Yeah, if you look at the way that we've managed the company since the beginning, we've taken the decision not to hedge. So we think our shareholders are able to do that if they want, and they can potentially do it better than what we can do. So we're fully exposed to the high-grade iron ore and to all the upsides that could come in the actual pricing. Where we do protect the company is obviously in the way that we structure all of the US versus Canadian transfers. We get paid in US. Most of our costs are in Canadian. So that's definitely one of the areas where we protect the company. We've taken all of our debt in US dollars as well. So sort of a natural hedge in terms of currency. And when you look at the way that we structure all of our contracts, we've got all of our Japanese contracts that are backward looking, and pretty much all of the other contracts that we have around the world, which are more forward looking. So we've sort of spread out all of these different contracts. And the way that we've selected our clients, we typically sell more spread out through the year to all of our customers, meaning that whether I sell into Japan, I'll sell one vessel every month or one vessel every quarter. So that way, while it spreads out over the years, sometimes there's some little upticks in terms of the pricing that we get. Sometimes it's a little bit lower, but if you flatten it out and look at a yearly average for us, we managed to get the full P65 index for our material. So the way that we've structured our contracts allows us to manage to get the full premium. The way that we structure our freight is that we're small enough of a company to be able to find these niche vessels that if they've come close to Canada and they don't have a route back, well, we can select it. So that way we're able to minimize our freight costs. And when you look at the clients that we select, well, as we mentioned, we're transitioning to get them closer to home.
Right. Okay. And I guess talking of premiums as well, we've talked in the past about premiums for, the quality or the purity of what you're doing versus, and also penalties, I guess, because that could be rather asymmetric in nature. How stable are those kind of thresholds for, wherever you're selling into, EU, MENA, Japan, wherever?
Well, the good thing for us is that we've got an extremely stable ore body. So we don't have fluctuations in our grade. which allows us to get very good clients because they know that each time they're going to buy a vessel from Bloom Lake, it's on spec. So we've never had any vessels that were not on spec and subject to major penalties. So that's definitely one of the advantage in us securing the best potential clients. So that's why we're able, with our new product, even if it's not been delivered yet, to already start securing contracts with major steel makers in the Middle East, in North Africa, and in Europe.
Okay. And then in terms of, sorry to dwell on this, because it's you're in that really kind of fully commercializing, optimizing your commercial strategies here. When it comes to things like termination or volume flex clauses with these contracts, and you talked about being fully exposed, right? So, how do your long-term contracts allow counterparties to reduce or reprice volumes when they're kind of with the spreads between P62 and P65 widen or compress? Again, is that something you're exposed to?
Yeah, if you look at the way that we've evolved in terms of our company, so when we delivered our first plant in 2018, well, we signed quite a lot of long-term contracts for our material, which didn't necessarily allow a lot of that flex. Once we delivered our phase 2 project in 2022, we already knew we were going to build or wanted to build a new project to upgrade the material. So that's why most of the tons of our phase 2 were sold on spot. So that's why you've seen some discounts for our material over the past few years, because we were exposed to half of our tons pretty much sold on spot pricing. As we get into this new product that we're going to make, well, we change the kind of clients to who we sell. They need this material. So it's not so much a game of playing, well, I can make more money by buying lower grade iron ore and then being able to produce a little bit less, have a bit more emissions. We sell to people that use our material that need this DR grade material. So that the big advantage is that we're going to get into longer term contracts for half of those tons, and that's going to reduce that sort of fluctuation in terms of premiums or discounts.
Are they kind of predictable in terms of the way they behave when there's a downturn or an upturn?
Pretty predictable. Honestly, like we know that if iron ore price dips to a certain level, well, India shifts from being a net exporter to a net importer of iron ore. So we typically, if you look at our sales over the past 7 years, we've sold into India every time that the price dipped. So we know that that's sort of a natural protection in terms of pricing. We have seen premiums for our material go up to $45 per ton. Today, it's pretty much at a historical low. So as we go into the next years and we get into a bigger transition into decarbonizing the steel industry, well, definitely we think those premiums can increase. So we have seen those sort of shifts. Is it predictable to a sense that we can put a date on it? No, but we know the trends make quite a lot of sense for us to position our material.
That's interesting. So there's a fairly kind of dynamic routing strategy that you employ. Is that what you're saying? Or are the contracts destination locked right now?
Well, right now, because we have a lot of our tons that are subject to spot or that are sold more on the spot, we've got a whole lot of flexibility to be able to play those different market trends.
Right. And in terms of your view of the way the kind of pellet feed portion will operate, is that very, very different, or is that just again, does it just come back to routing strategy at that point?
Well, it's very different for us because if you look at the geography today, we're at a big disadvantage when we sell from North America because we sell to China, which is right beside Australia, and Brazil is closer as well. As we transition to this new material, we're going to sell much closer to home. So that disadvantage becomes an advantage because when we sell to Europe, well, we're the closest ones to Europe. When we sell to North Africa, we're pretty close. To the Middle East, it's a little bit the center point, so there's no advantage or disadvantage compared to others. So this new material is really going to give us that flexibility to turn what is today a disadvantage of our company into an actual advantage.
Right. Okay. And then and when you're looking at that ramp up phase that you're going to be negotiating, like, take or pay or volume floors or tolling arrangement, whatever you do. But when you're looking at that counterparty, what's important to you?
So when we look at selecting clients for this new material, what's important, one, is they need to have access to a port that allows us to sell Cape-size vessels because we want to reduce cost as much as we can. we need to have a company, obviously, that we can trust that it's going to be there next year. So we want to be with reliable customers. And we're at a size of company that we typically compete with very large companies. So we've got that advantage of finding some smaller steel manufacturers that sometimes don't get access to this high-grade material because they don't buy enough, but we can have some more equal to equal negotiations. And for us, it makes sense to spend 3 years to negotiate a 1 million ton per year contract because that's a significant portion of our new material. If you're a large company like Vale, to spend 3 years to negotiate a 1 million ton contract when you make 300 million tons or 350 million tons per year doesn't make a lot of sense. So when we select our clients, the port needs to be good. We need to make sure that we make the best premium possible with that sort of niche client that we can sell our niche product to.
Okay, so credit strength doesn't really kind of come into it. You assume that.
Yeah, when you look at steel manufacturers, I mean, it's so infrastructure heavy. They're typically protected by governments as well because steel is very important. So that's definitely credit is something that we'll look at, but we've never sold to any clients that have defaulted. And the big advantage that we have is the size company we are. We try to focus on where we can create value, and we find the right partners to help us on the other front. So we're partners with Glencore, and they have a marketing arrangement. So they take all the credit risk in terms of the actual sale once it leaves the port. So it allows us for a small fee to be able to protect ourselves as well when we sell our material.
Buyer behavior and client portfolios, etc. Looking forward, let's look forward. You're building up cash. You got some options, sort of like how you allocate that cash. In terms of things that you do, a lot less capex, a little bit more OPEX. What's 2026 hold for you and your shareholders?
I think 2026 is an amazing year for Champion, just because we're transitioning from what was a more semi-niche material, so the high grade, into the highest grade that you can find. So we're getting into this DR grade material, which is what is going to be required for all this transition of the steel manufacturing into greener steel. And yes, we've probably seen a little bit less focus on this when you read the media in terms of what's happening in the US, but we're still seeing that transition happen. And when we look at the market, we don't see a whole lot of new tons coming into that niche market. So 2026 for us is where we end our large capex cycle. So 7 years of heavy investing, over $2 billion into our asset. It's the year where we deliver our new product and get to sell material closer to home. So it's a year that we should be able to generate quite a lot of returns for our shareholders. And as you mentioned, we'll be able to evolve in the best way possible to return that cash to our shareholders.